You remember in the previous video on the trick to spotting market waves early, I spoke about how the market tips its hand to those who pay attention. How the rhythm shows itself if you're patient enough to wait. Today we're going to get into something even more essential, and something that separates the men who stay in the market from those who wash out of it. Why do most traders fail at trend following? You'd think it's the simplest of all games. The market is going up, so you buy. The market is going down, so you sell short. But if it were that simple, the graveyard of trading accounts wouldn't be filled with the bones of men who tried exactly that. Let me ask you something. How many times have you seen a stock climbing and thought, it's too high, I can't buy it now, and then the very same stock doubles again while you sit there shaking your head? That's the first reason most fail at trend following. They don't have the nerve to buy strength. They think buying high is foolish. They want bargains, like they're in a department store. But in the market, strength begets strength, and weakness begets weakness. Buying cheap is a habit of the amateur. Buying strong is the discipline of the professional. Another reason, they don't stick with their winners. A man will cut his profits short because he's afraid of losing what he has on the table. He watches a gain pile up, and then the first little dip comes, and he sells, patting himself on the back for taking a profit. Meanwhile, the big money was in the long swing he never let run. The market rewards the man who can sit tight, not the one who jumps at shadows. Have you ever looked back at a chart and realized the real fortune was in the move you exited too early? You see, most traders want action, not wealth. They crave the thrill of being right today, not the satisfaction of compounding capital over years. They take every squiggle on the chart as a signal and end up dancing themselves into exhaustion. Trend following, on the other hand, is boring to them. It demands patience, silence, and discipline. That's why they fail. It isn't complicated charts or complex theories. It's because they can't bear to wait. Tell me honestly, do you have the stomach to do nothing while your capital works in the market? I've said many times before that speculation is not a game of brains, but of character. The market does not pay you for brilliance. It pays you for consistency. Most trend followers fall apart because they don't trust their own rules. They see a trend, they enter, but the moment the market shakes them with a counter move, they panic out. They mistake a little noise for a change in the tune. And yet, the great moves, the ones that make fortunes, always come with such shakeouts. If you're expecting a straight line, you're in the wrong business. The tape does not oblige wishful thinkers. And then there's the problem of leverage. A man sees a trend, piles in with borrowed money, and the first pullback wipes him out. He had the right direction, but not the right position size. Do you know how many good trades end in ruin simply because the trader bet too much, too soon? The market trend didn't beat him, his greed did. Now, think about what we said last time, when we talked about catching those waves early. Spotting the swell is one part of the game, but riding it without falling off, that's the real art. That's where trend following demands something beyond chart reading. It demands temperament. Because what use is spotting a wave if you panic out halfway? The connection should be clear. Catching the wave is entry, but following the trend is survival, and most men fail at the survival part. Why else do they fail? Impatience, mostly. A man starts with a plan, but the moment the market takes longer than he expects, he tinkers. He changes his rules midstream. He adds indicators, reads new books, chases opinions. But the market doesn't care about your inventions. The tape is older than you and me. The rules haven't changed in 100 years. Price moves in trends, and the only way to profit is to go with them. If you won't trust the rule, then you're doomed to chase noise. Do you really think you can outwit 1,000,000 traders by inventing a clever trick? I've watched countless men sabotage themselves by searching for certainty where none exists. They want guarantees. They want to know that the trend will last exactly this long, or end at precisely that level. But the market doesn't hand out schedules. All it does is move, and your job is to move with it until it stops. If you require certainty, you'll never follow a trend, you'll cut it short every time. Ask yourself, Are you willing to live with uncertainty in order to capture the certainty of profit in the end? Another reason most fail is that they confuse trend following with prediction. They think they have to forecast where the market will go. But that's not trend following. Prediction is trying to be smarter than the market. Following is accepting that the market is smarter than you, and that it'll show you the way if you let it. Too many men wreck themselves trying to guess instead of trying to follow. Which do you spend more time doing, guessing or following? It's the same with reversals. Every failed trend follower I've known tried to call tops and bottoms. They couldn't resist it. They saw a trend and thought, it's gone too far. But markets can go farther than your imagination will allow. Tops and bottoms are only visible in hindsight, yet amateurs insist on finding them in advance. That's why they fail at following. They don't follow, they anticipate. And anticipation is where the money vanishes. The right way is to act only when the market confirms. You wait for price to prove its direction, and then you align yourself with it. No guessing, no hoping, no fighting. Just following. But the ordinary trader thinks that's too late. He wants to be early to catch the exact turn. He doesn't realize that being early usually means being wrong. Don't you see? The whole advantage of following is that you don't have to predict. And what about discipline? Without it, trend following is impossible. A man will set a stop, but then when price comes close, he moves it. He tells himself it's just noise. Then the market blows through his line, and his small loss becomes a large one. The trend continues, but he's no longer in the game. He had the right idea, but no discipline to take the small hit. Have you ever moved a stop and regretted it? That's the mark of the amateur. Trend following is simple, but it is not easy. It requires 3 things: patience to wait for the right move, courage to enter when it looks too high or too low, and discipline to stay with it until the market itself tells you it's over. Most fail because they lack one of these 3, and many lack all of them. They want the reward without the waiting, the profit without the pain, the trend without the shakeouts. But the market doesn't operate on their terms. You see, the big problem is human nature. Men are wired to seek comfort and avoid discomfort. Yet in trading, comfort leads to ruin. It's comfortable to take a small profit. It's uncomfortable to risk sitting through a pullback. It's comfortable to move a stop farther away. It's uncomfortable to accept a loss. The man who chases comfort will never follow a trend to the end. Do you notice how your greatest mistakes always felt comfortable in the moment? The first stumbling block that causes most traders to fail at trend following is their fear of buying strength and their obsession with trying to find cheap entry points. It sounds harmless enough, even logical, because we've all been conditioned since childhood to look for bargains. You hear it everywhere: buy low, sell high. It sounds sensible, doesn't it? But in the market, that kind of thinking is the ruin of more fortunes than I can count. The crowd wants to buy when a stock looks cheap, when it's down from its highs, when it feels comfortable. Yet the irony is, those are often the very moments when the stock is weak, when supply is overwhelming demand, when the trend is down. A cheap price in the market doesn't mean value, it means trouble. And still, traders keep repeating the same mistake. Think of how many times you've seen a stock making new highs, and your first thought was, it's too expensive, I missed it. You hesitate. You wait for a pullback, telling yourself it'll give you a better entry. But that pullback never comes, or if it does, you're too afraid to buy it. The stock keeps moving higher, doubling, tripling, while you're still sitting on your hands. And then, after the move is almost finished, you finally convince yourself to buy, just in time for the top. That hesitation, that fear of buying strength, is the undoing of so many traders who think they're being cautious, when really they're being short-sighted. The truth is that strong stocks in strong markets get stronger. Momentum is real. When institutions pile into a name, they don't stop after the first breakout. Their buying power is so large it takes weeks or months to build a position, and during that process, the stock keeps climbing. A trader who insists on waiting for a bargain never rides with that tide. He stands aside, shaking his head at the high price, not realizing that what looks expensive today may look cheap tomorrow. Have you ever noticed that the greatest leaders, those stocks that become legends, always looked expensive the entire way up? That's the paradox amateurs can't swallow. There's also a psychological trick at play. When a stock is down, traders feel safer buying it because they think the risk is lower. They think the stock has already fallen, so the worst must be over. But that's not how the market works. A declining stock is weak for a reason, and that weakness tends to persist. When you buy into weakness, you're stepping in front of a freight train. The trend is down, the institutions are selling, and you're betting against the tide. And yet, because it feels comfortable, because the price is low, traders convince themselves it's the smart play. Comfort kills. The easy choice in the market is usually the wrong one. On the other side, when a stock is climbing and pressing into new highs, traders feel nervous. They imagine they're the last fool to buy. They think it's reckless to pay more than anyone else ever has. But this nervousness is exactly why so few are able to hold on to big winners. It takes courage to buy when everyone else is muttering that the stock is too expensive. That courage is what separates the profitable trend follower from the losing bargain hunter. Ask yourself, when was the last time you bought a stock at its highest price ever and held it? Chances are you can't recall, because your instinct was to wait for it to come back down. Let me tell you, the market does not reward hesitation. By the time a stock is making new highs, the trend is established. It has proven itself. Price is the only fact that matters, and price strength is the clearest signal that demand exceeds supply. If you ignore that fact, because it doesn't fit with your bargain hunting mindset, you will watch opportunities pass you by again and again. Most traders never retrain their minds to see strength as an invitation instead of a warning. That's why they fail at trend following. There's also the problem of ego. Many traders want to feel smart, like they picked the bottom. They boast about catching the exact turning point, about getting in when no one else saw it. But following strength isn't about being smart, it's about being aligned. The tape is telling you where the money is flowing. You don't have to outthink it. You don't have to anticipate it. You just have to follow it. Yet, men would rather cling to the illusion of cleverness than collect the real profits that come from simply following. Isn't it strange how being right in theory matters more to them than being profitable in practice? Another reason traders shy away from buying strength is that they underestimate how far trends can carry. They look at a chart, they see a stock that's doubled, and they assume it can't go higher. They think the move is overdone. But the market has no such limits. A stock can move 5, 10, 20 times its original price when the conditions are right. The big moves always look overdone in the beginning. If you're judging by past prices instead of current momentum, you'll always think it's too late. That's why traders who insist on bargains spend their careers missing the very moves that create wealth. Now, think about how this ties into money mindset. A man who insists on buying cheap is a man who doesn't trust abundance. He's playing not to lose instead of playing to win. He thinks in terms of scarcity, of holding on to nickels instead of reaching for dollars. To follow a trend, you must think bigger. You must allow yourself to believe that the market can carry your stock far beyond what feels reasonable. You must give up the false security of cheap entry points and embrace the discomfort of paying up for quality. That shift in mindset is the difference between scraping for crumbs and sitting at the table where fortunes are made. And here's where the discipline of chart reading comes back in. A chart doesn't lie. When price is making higher highs and higher lows, when volume is expanding, when breakouts are sticking, that's strength. The tape is telling you the truth. Demand is overwhelming supply. To ignore that because you think the stock is too high is to argue with reality. And the market doesn't pay you for arguments, it pays you for obedience. Following the chart means buying strength even when your gut says it's dangerous. Are you willing to trust the tape over your own emotions? That's the question every trader must face. The irony is that most who fear buying strength have no problem holding weakness. They'll buy a stock because it's down, and then when it falls even further, they hold it, refusing to sell because they don't want to take the loss. They'll keep averaging down, telling themselves it's a bargain. Meanwhile, when they buy strength and it dips even slightly, they panic out immediately, unable to stomach the thought of being wrong. So they cut their winners and ride their losers. That's the exact opposite of what trend following requires. Isn't it remarkable how human nature tricks men into reversing the formula for success? You can see now why the fear of buying strength and the obsession with cheap entries ruins so many traders. The very instinct that feels safe is what sabotages them. They cling to bargains and avoid strength, not realizing that the big money is made in strong stocks moving with the tide, not in weak ones bouncing against it. Until a trader learns to invert that instinct, to buy strength and avoid weakness, he will always struggle to follow trends successfully. Another great reason most traders fail at trend following is that they can't resist the urge to cut their profits short. They see a gain on the table, and instead of letting it grow, they snatch it at the first sign of a pullback. It's as if the moment they're in the black, their whole objective shifts from building wealth to protecting a small trophy. They call it locking in profits, but what they're really doing is sabotaging themselves. The market doesn't pay you for grabbing crumbs. It pays you for sitting tight through the feast. Yet most traders don't have the temperament to wait. Think about your own trades. How many times have you entered at the right spot, watched the stock climb, felt a thrill of being right, and then sold after the first little retracement? You walked away with a modest gain, proud of your quick judgment, only to watch the stock climb another 30%, 50%, even 100% after you exited. You told yourself you'd wait for a re-entry, but when the stock kept running higher, you froze. You had the trend in your hand, and you let it slip away. That is the story of why most fail. They don't stay for the main move. The hard truth is that the big money is not made by trading in and out of every wiggle. It's made by identifying a true trend and riding it for all it's worth. The great moves, the kind that change account balances in a serious way, take time to unfold. They need weeks, months, sometimes years. A trader who can't sit tight for more than a few days will never capture them. The short-term thinker might make a string of small wins, but he'll miss the one trade that would have paid more than all the rest combined. And without that one big winner, his equity curve never climbs high enough to cover his inevitable losses. Now, why do men cut profits short? Fear, mostly. The fear of giving back what they've gained. They see their account up by a few points, and the possibility of losing it terrifies them more than the thought of multiplying it excites them. They'd rather pocket a small, sure thing than endure the uncertainty of staying in. It's human nature to value what we already have more than what we might gain. But in trading, that instinct is fatal, because the market gives its biggest rewards only to those who are willing to risk seeing temporary paper profits shrink in order to let long-term profits grow. Ask yourself, how many times have you taken a small gain only to watch it become a massive gain for someone else who stayed? Another reason traders cut profits short is impatience. They want results fast. If a stock doesn't explode immediately, they grow restless. They sell and move on to the next name, thinking they'll catch something quicker. But trends don't work on your schedule. The market doesn't reward restlessness, it rewards patience. Many a trader has sold out of boredom, only to see his boring stock come to life right after he left it behind. Trend following is a waiting game, and most men don't like to wait. There's also ego involved. Some traders want to be right too often. They care more about a high win rate than about the size of their wins. So they cut profits short to lock in those little victories. They'd rather boast about being right 70% of the time than admit they only need to be right 30% of the time if they let their winners run. It's not about how many trades you win, it's about how much you make on the winners versus how much you lose on the losers. But ego blinds them. They chase approval from their own scorecard instead of listening to the markets. Which would you rather have, a dozen tiny wins that add up to nothing, or a handful of big wins that build a fortune? Another trap is that traders don't trust the trend once they're in it. They second guess every dip, every sideways move, every bit of noise. They think the trend has ended the moment the stock breathes. But trends don't move in straight lines, they ebb and flow. If you sell at every ebb, you'll never be there for the flow. The very act of following a trend requires accepting that you'll sit through pullbacks, through consolidations, through uncertainty. Most traders don't accept that. They want perfect, linear moves, and when they don't get them, they bail out too soon. Do you notice how your best trades often felt the most uncomfortable before they paid off? Cutting profits short is also a sign of poor planning. A trader who doesn't know in advance how he'll manage a winning trade will always fall back on fear when the heat comes. He hasn't decided whether he'll trail a stop, scale out, or ride it to a specific technical signal. So when the market tests him, he improvises, and improvisation in trading usually means panic. Discipline is what keeps you in the trend when your instincts are screaming to take the money. Without that discipline, every little pullback becomes an excuse to cash out. This mistake also ties into the money mindset. A man who cuts profits short is often a man who thinks small. He's satisfied with modest gains because he doesn't believe he deserves more, or he doesn't trust the market to give him more. He acts from scarcity, afraid the opportunity won't last. The successful trend follower, on the other hand, thinks in terms of abundance. He knows that the market is capable of delivering outsized moves if he has the courage to hold on. He's willing to let a profit grow far beyond what feels reasonable. That difference in mindset is what builds wealth. Consider how institutions behave. They don't buy a stock for a quick point or two. Their positions are so large that it takes them weeks or months to accumulate and weeks or months to exit. They ride trends because they have to, and in doing so, they create the very trends that retail traders fear to hold. If you align yourself with them, you must be willing to stay as long as they stay. Selling too soon means you miss the very part of the move that the big players are engineering. Why would you let them push the stock higher without you on board? When you look back at charts of great market winners, you always see the same story. A stock breaks out, pulls back, consolidates, then runs higher, often through multiple stages. The early holders who panicked at the first pullback missed the bulk of the move. The few who sat tight through the noise captured the fortune. History repeats itself because human nature repeats itself. Most will never learn to stay. Will you? And this is where trend following really separates itself from prediction. You don't have to know where the stock will top out. You don't need to forecast the exact price target. You simply follow the move until the market itself shows you the trend is over. Until then, your job is to sit. But most traders can't stand the uncertainty, so they exit long before the market gives them any reason. That's why they fail at trend following. Most traders fail at trend following because they don't actually want wealth, they want action. That might sound harsh, but it's the plain truth. They come into the market with visions of fortune, but what they're really chasing is excitement. They crave the rush of being in a trade, the thrill of seeing numbers flicker on the tape, the satisfaction of doing something. But the market doesn't pay you for excitement, it pays you for patience. And patience is boring. Following a trend often means doing nothing for days, weeks, sometimes months, and that's unbearable for most men. They'd rather trade every move, win a little, lose a little, and feel alive in the process, than sit still and let a real trend compound their capital quietly. Have you noticed how traders often brag about the number of trades they make instead of the size of the profits they keep? It's as if activity itself is the badge of honor. They talk about how many positions they turned over in a week, how many times they were in and out of a stock, as though being constantly busy proves they're professionals. But the professional trader knows that less is more. The fewer the trades, the better the quality, the greater the profit. The amateurs hide behind activity because they lack discipline. The tape is a mirror, and they don't like the reflection of inactivity staring back at them. There's an old saying that the market is designed to fool the most people most of the time. One way it does that is by tempting them with endless little movements, ups and downs that look like opportunities, but are really distractions. The amateur chases them, believing he's catching every wave. The trend follower ignores them, waiting for the real move to declare itself. That difference in approach is the difference between mediocrity and wealth. Do you ever feel the itch to trade just because you haven't been in the market for a while? That itch is the enemy of trend following. The action seeker is addicted to novelty. He loves scanning for new tickers, chasing rumors, hunting the next big thing. He's restless with a stock once it's in his account, always looking for another one that might move faster. He thinks diversification is having 10 or 20 different trades on at once, each for a quick flip. But diversification in trading isn't about being everywhere, it's about being where the big move is and staying there long enough to let it work. The man chasing action is spread thin, never concentrated, never committed. He's in love with the game, not the result. And here's the cruel twist: the market knows how to feed that craving for action. It gives quick profits, just often enough to keep the gambler hooked. A fast win here, a lucky scalp there, and the trader convinces himself that constant action is profitable. But over time, the small gains don't add up. They barely cover the commissions, the slippage, the inevitable losses that come with overtrading. Meanwhile, the trend follower who took only 1 or 2 positions in the same period sees his account multiply. But the action chaser doesn't notice. He's too busy chasing his next thrill. This is where psychology and money mindset tie together. A man who seeks action over wealth isn't truly serious about compounding capital. He doesn't think in terms of building something lasting. He thinks in terms of short-term gratification. It's the same mindset that makes men blow their winnings at the racetrack or casino. The rush is the reward, not the money itself. But trading isn't supposed to be thrilling. It's supposed to be profitable. If it feels too exciting, you're probably doing it wrong. Have you ever left a trading day feeling drained? Not because you lost money, but because you couldn't stop trading. That's the hallmark of action seeking, and it's poison for trend following. Now let's talk about boredom, because that's what most traders can't stomach. Following a trend means sitting through stretches where nothing seems to happen. The stock consolidates, the volume dries up, the price drifts sideways. To the action-hungry trader, this feels like wasted time. He sells out, convinced he can use his capital somewhere more exciting. But often, that quiet consolidation is exactly what precedes the next leg of the trend. The trader who sat still through the boredom is rewarded. The one who jumped ship misses the move. The ability to endure boredom is one of the rarest qualities in trading, and that's why so few capture big trends. Consider how many traders get shaken out of positions during these quiet phases. They can't stand watching their stock do nothing while other names on the screen are moving. They feel like they're missing out, so they exit, only to chase something else. By the time their original stock breaks out, they're already tied up in another trade, usually one less promising. Action seekers are always in the wrong place at the right time. They mistake movement for opportunity and overlook the power of patience. Do you see how the market punishes those who can't sit still? And there's another layer: most traders measure success by daily or weekly results. They want to make money every day. That's the mindset of an employee, not a trader. Employees expect steady paychecks. Traders must accept uneven distributions of profits. You might make nothing for weeks, and then earn more in one trend than in 6 months of churning. If you can't handle that uneven rhythm, you'll never let a trend pay you fully. The obsession with daily action is a symptom of wanting trading to behave like a job. But trading isn't a job, it's a game of capital patience. The irony is that real trend following often feels like doing less, not more. You enter your position, you set your stop, you monitor the trend, and you wait. Days can go by with no decisions to make. Weeks can pass where your best move is to hold. To the action chaser, that feels unbearable, like laziness. But it's the very thing that creates wealth. The hardest work in trading is often the discipline of not working, of resisting the urge to manufacture activity when none is required. Can you stand the silence of doing nothing while your account grows in the background? That's the real test. Now, think back to the principle we spoke of when spotting market waves early. That skill means nothing if you can't then ride the wave. And riding it means staying on board while it swells slowly, not jumping off because you're bored or restless. The man who wants action keeps paddling into every ripple, never catching the full wave. The trend follower waits for the one true swell, commits and rides it all the way. That's how the principle ties together. Spotting is one thing, but following demands patience through boredom. And that patience is what most men don't have. The truth is, action is costly. Every trade costs money, spreads, slippage, commissions, mental energy. The more trades you make, the more the market takes back from you. The fewer, higher quality trades you make, the more of your capital you keep. The action chaser ignores this math. He burns through his account with constant trades, convinced he's building skill, when in reality he's digging a hole. By the time he realizes it, the trend he should have been riding has already passed. If you really want to know why most traders fail at trend following, look at their journals.